Hello and welcome to the Financial Markets Market View video presentation. This is Charles Curran along with my other FX clan members, Tom Harris and William Sloan, and we will be presenting the Australian dollar against the US dollar. Currently the exchange rate for the Australian dollar versus the US dollar sits at around 80 cents at 0.79312. We got this information from the Reserve Bank of Australia, otherwise known as the RBA, on the 21st of September 2017. And if we have a brief look at the history of the last 6 months, the short-term history, we can see that on average the exchange rate has increased by around 65 pips per month.
The traditional view for relative interest rates was that a high relative interest rate would encourage capital inflow and thus increases the demand for the respective currency, whilst at the same time this discourages capital outflow, decreasing supply of the respective currency. The net effect of this being an appreciation of the currency. On the other hand, a low or decreasing interest rate would discourage capital inflow and decreases the demand for the relative currency. In the case of the Australian cash rate, currently sitting at 1.5%, when compared to the US cash rate sitting at 1.25%, one would expect, given that Australia has a higher relative interest rate, that the demand for the Australian dollar would be higher relative to that of the US dollar. The demand for the Australian dollar would increase as foreign investors capitalise on the higher relative interest rates. The investors see the higher interest rates as an opportunity to maximise their return, as every dollar invested would provide a greater relative return. As the demand for the Australian dollar increases and the supply decreases, the net effect will be an overall appreciation of the dollar in the short-term future. As Australia's international competitiveness increases and foreign investment rises, the demand for the US dollar is decreasing whilst its supply is increasing. This is due to the relatively lower interest rates, leaving little incentive for foreign investment. The overall net effect of this is a depreciation of the US dollar in the forthcoming months.
As America's inflation rate is at 1.7%, which is comparatively lower to that of Australia's inflation rate at 1.9%, this percentage to overseas importers will find American goods and services more attractive, as they are cheaper in nature. A higher inflation rate in Australia means that Australian goods increase at a faster pace than those of American. One repercussion of Australia having a higher inflation rate is that Aussie goods will become less price competitive, meaning Australians will search overseas for goods and services as they are cheaper. Because these are overseas transactions, they have to be denominated in a foreign currency, meaning there is an increase in the supply of AUD. On the other hand, if there is a decrease in the demand for the AUD, and an increase in the supply for AUD, this will see the Aussie dollar depreciate relative to that of the US dollar. The US inflation rate is still lower than that of the Australians at 1.7%, meaning the price increase is slower than that of Australia's. As a result of this, American goods will become more price competitive and more attractive to overseas buyers. Like anything more attractive, there is an increase in demand. A greater demand for US goods and services from external importers will see an increase in demand for the USD. The economy will search domestically for products more so than internationally as the US becomes more price competitive and US products becoming more accessible, with imports decreasing. To conclude, in the months to come, if an increase in the demand for USD and a decrease in the supply for USD, this will ultimately see the USD appreciate relative to that of the AUD.
Traditionally, one of the higher levels of economic growth is an increased demand for imports. The demand for imports increases for several reasons, following strong economic performance. For instance, as a country has relatively strong economic growth rates, the proportion of income classed as disposable will increase. As disposable income increases, consumers are more willing and able to consume products. As the demand continues to boom and capacity constraints begin to arise, consumers are forced to look elsewhere to consume products, and thus this increases imports. This will ultimately increase the supply of the respective currency, shifting the supply curve to the right. Another effect of strong levels of economic growth could be an increased level of overseas investment. This will increase the demand for the respective currency, shifting the demand curve to the right as well. This is the case for the US, where they have seen an increase in GDP of 0.2% from last quarter, where they currently sit at a GDP of 2.5%. Thus, as the GDP for the US increases, they will see an increase in both demand and supply for the US dollar, therefore leaving the net effect of these two factors difficult to predict in advance. If the level of demand and supply were both to increase at a constant rate, the value of the US dollar would remain consistent. However, if the supply increased in an amount higher than the increase in demand, the value of the US dollar would depreciate, and vice versa. As the level of GDP in the US climbs, the Australian GDP falls in relative terms. The GDP level for Australia has fallen 0.3% over the last quarter and now sits at 2.4%, which is 0.1% lower than the current rate of the growth in the US. An effect of the decreasing level of economic growth is a lower demand for imports. This is due to the lower level of disposable income, and thus the supply of the Australian dollar will decrease. As the supply of the Australian dollar falls, the overall net effect will be an appreciation in the Australian dollar in months to come.
Although historical data at times may be hard to extrapolate, it remains as the only unbiased way to measure risk and make decisions about the future. The term used for this is technical analysis. Technical analysis works by recognizing the rate patterns and trends and tries to explore those trends. After the mining boom in Australia brought the Australian dollar to an all-time high against the US dollar, traders were frequently attracted by the interest rate differential between the currency pair. However, recently, as the economic growth of China slowly decreases, the demand for Australian commodities fall too, thus creating a more skeptical future for Australia's financial prospects.
The short-term future for the currency pair is determined by a number of factors, namely the exchange rate determination, which includes a number of important economic indicators. The future trends of the currency pair can also be determined by the past performance of both respective currencies. The economic indicators we considered to determine our belief of the future trends of the respective currencies include the relative interest rate, the inflation rate, and the economic growth rate. According to NAB Australia, the expected cash rate in Australia is expected to maintain the same rate as the previous 6 months, remaining constant at 1.5%. The US cash rate is also expected to remain at its current rate of 1.25%, according to NASDAQ. The RBA predict that the inflation rate in Australia will be around 2% in early 2018, an extremely slim increase from the current rate of 1.9%. The US inflation rate is also expected to be around 2% early on in 2018, another slight increase from the current rate of 1.7%. The RBA predicts that the Australian growth rate will be between 2 to 3% early on in 2018. This remains fairly consistent with the current growth rate of 2.4%, whilst the US growth rate, currently sitting at 2.5%, is expected to decrease to 2.2% by the beginning of 2018. Upon observing the relevant economic indicators and reflecting on past trends of both currencies, we have determined that both currencies will remain fairly consistent, perhaps fluctuating slightly as both countries' inflation rate increases, which causes the supply of both currencies to increase, thus depreciating their value. The RBA predicts the Australian growth rate will remain fairly consistent. However, the US growth rate is projected to decrease by the beginning of 2018. The decreasing growth rate of the US, however small, may lead to a potential appreciation of the US dollar relative to the Australian dollar. Overall, considering all relevant economic indicators, we believe that the US dollar will slightly appreciate relative to that of the Australian dollar.